And we're keeping an eye on the markets after January U.S. CPI report was released this morning alongside a wave of corporate earnings. So for more perspective on all of that, we're joined now by John Zechner, chairman and founder of Zechner Associates. It's good to have you join us this morning. Good morning.
Hey, good morning, Lindsay.
So let's start with those CPI numbers. Rose 2.4% year over year, slightly below estimates, maybe not exactly what the Federal Reserve wanted to see. What do you make of these numbers?
Yeah, you're right, Lindsay. The headline was maybe a tenth below. The core was right in line, and it's still sticky in this 2.5% range. It's you've got a lot of mixed economic data, so it's a hard read for the Fed. And I think the leading of the governors, you hear most of them talking, is really just to stay the course for now, because in the absence of knowing whether the economy is running too hot or too slow, they'll just they cut rates three-quarters of a point. I think they're happy to sort of leave it at that for now. And yeah, obviously you're going to get with Kevin Warsh coming in, he's going to try to tilt some members more in the direction of lower rates, but that's going to be a tough call when you listen to what they're saying. And the economic data is mixed. I mean, that employment report the other day, Lindsay, that really surprised me. I mean, it was stronger than expected, and that's after sort of a soft, ADP, soft challenger job numbers. JOLTS numbers were all a little weaker. I would have taken the under on that number and it sort of beat. Trump really wants to run this economy a little bit hotter, and I think he thinks that's going to help his chances in the midterms, and he wants to get the Fed on side to cutting rates to do that. So there's a lot of mixed economic signals. I don't think this changes anything for the Fed in the near term, and they'll just continue to watch how these numbers play out. For now, the economic data is surprisingly resilient.
That was going to be my next question: is whether this changes anything in terms of how many rate cuts, if any, you expect to see this year. Some analysts saying 2, some saying 3, but you think it doesn't really change much. Like the number hasn't changed that much, really.
Oh, no, exactly. I've seen some saying, no rate cuts this year, because if you play the other side of the coin and they try to run the economy a little bit hot, because you've got the one big beautiful bill out there with the tax cuts, so that's stimulating some consumer spending. You still got this K-shaped economy, which sort of favors the higher end consumer, and they're still spending. You saw that in the airline numbers this morning and things like that. Whereas retail sales numbers, which the whole economy are softer, so it really is a mixed bag, but there's still, you got massive fiscal spending out there still. You're doing over 6% deficit to GDP ratio, which is almost unheard of for like a non-war, non-recessionary time. So it's like it's pedal to the metal in terms of what they're trying to do to the economy. So in that environment, boy, it's hard to raise the argument, hey, we got to cut interest rates dramatically. But that's what the president is pushing for and what he wants. I think that's what the gold market is telling you. They're worried about that risk, and I think that's why long bonds are still in the U.S. still trade up around 5%, because they believe that inflation and excessive growth is still as big a risk as weakness.
For sure. Okay, that's something to watch. But we're also watching a slew of earnings coming in this week once again. So I want to get your thoughts on a couple of them. We'll start with Cameco. So Cameco earnings beat estimates boosted by a lift in uranium. I'm wondering what you make of the numbers there and that report.
Yeah, the numbers were a bit of a beat, not on production and not from the Westinghouse side, which is the contracting for nuclear reactors, which is a good business that they added. It was really the price of uranium, which is stronger. My issue with Cameco, and when we've reduced the name, actually almost eliminated from the portfolios recently, just on valuation, trading at 35 times forward cash flow. If I was going to play, I'm positive on uranium longer term. I'd rather do it a cheaper way, which play the Sprott Physical Uranium Trust, the U.T in Toronto, something like that, play it directly. So that helped. But, clearly people love the story, and it is the go-to play on a global basis in uranium right now.
Another one, Agnico earnings. Agnico, this is really interesting to me because they topped Barrick now in one of the biggest gold output producers in the world. What do you make of the latest earnings report coming in from Agnico?
You know what's really interesting about those numbers, Lindsay? It's just the way you look at their all-in costs, and I mean, the cash costs are running around $1,100 an ounce. The all-in cost, around $1,500 an ounce, which is for years when gold was around $2,000. They're profitable companies, but not hugely profitable. Those costs stay the same, and suddenly you're looking at $4,000 or $5,000 for gold. That's why these stocks are soaring, because all of that money flows to the bottom line. They've got the production in place. They don't, that it doesn't cost them any more to maintain sustain that production. So it's all free cash flow. They can start buying back stock, and that's why these stocks have been soaring. So it's going to be an interesting tale to tell going forward what these companies do with some of that excess cash. And clearly, if gold's prices stay around these levels, these guys are going to be just printing a ton of cash, and it's good for the stock. They could do more buybacks. Maybe there's more corporate activity. I don't know, but it certainly just it illuminates how profitable the gold business, mining business is right now.
It does seem like so many of these gold mining companies just soaring on the high gold prices. Obviously, you wonder how they'd be doing if gold prices weren't so hot at the moment.
Well, we've been up and down cycles with that. I've been doing this for 40 plus years, Lindsay. And I've seen these cycles where they all start to spend at the top and they buy each other. And they've shown a better discipline this time around. And I think that's why the stock prices are acting better, because they're not going out and sort of making the crazy acquisitions or even putting the money drilling into the ground, because those costs have gone up dramatically. I don't think anybody's brought a new mine into production on time and on budget in the past decade. So, it's better just roll out the production, improve the cost structures, and just take this money and give it back to shareholders, higher dividends, share buybacks, whatever. Shareholders love it.
We're just going to fire through a couple more of these before we're out of time. CAE Industries also beat estimates in their third quarter. They're reporting that. What do you make of that report?
Well, yeah, you nailed it before, Lindsay, in terms of the issue was civil. Civil is looking soft in the short term right now, and that's sort of been the driver. I mean, they're setting themselves up for defense longer term, but simulators have always been their business, and that's obviously tied to the building and training on aircraft and airlines. So that looks a little softer. They're doing a bit of a restructuring there. So, but yeah, I mean, the earnings generally are coming in well. I think the bigger tell is what's going on in the technology sector and why that's. I mean, that the one that blew me away this week was Shopify. Those are huge numbers. The stock went up 15% pre-market on Wednesday, finished the day down about 12%. That's illuminating in terms of what's actually going on in the market to see a reversal like that in a single day.
Yeah, Shopify had some pretty phenomenal earnings, and you believe management said all the right things in that earnings call when they were talking about, the report, public call it on the sell side, callback side.
Yeah, and I think the worries right now in the market is just that there's you're going to have so many disruptors. Suddenly, AI is not this great tailwind for the market. Suddenly, it's a destabilizing threat. You saw that the other day on the financials. A new app comes out, and that's going to undermine all the financial companies. That was the same thing for logistics yesterday. So, and the problem, I think, too, Lindsay, is just the over-owner. This just shows that too much money was in the market generally, and it's been all in tech. So people, as they unwind these bets, they overshoot on the upside, and then they're probably going to overshoot on the downside. So you create some great bargains in the process. And I think, Microsoft, Shopify, names like that are looking pretty good buys right now. But in the short term, yeah, they could go a lot lower. I saw this in 2001 and made the mistake of buying too early on the dip. And man, these things dropped 70, 80% before they finally bottomed out.
Yeah, it's going to be an interesting ride from here on. That's all the time we have today, though. John Zechner, chairman and founder of Zechner Associates. Always good to have you join us. Thanks so much.